Okay, let's explore this revenue recognition situation. We've got Stefan D'Angelo, and Stefan opened a hair salon on October 1st, 2014. He named it Sheer Magic. And let's explore these transactions and see if we can identify what's the total amount of revenue that should be recognized for the month of February. Okay, look at transaction 1. On February 2nd, 2015, Stefan transferred $3,000 from his personal account to the business account. Now, hopefully you recognize there's no revenue involved here. All right, I'm going to try to indicate what would increase and what would decrease. Okay, so if he transferred $3,000 from his personal account to his business account, the business would have an increase in cash. And remember, with the accounting equation, we always have to make sure that assets are equal to liabilities plus equity. So the increase in cash increases assets. We would also have an increase in equity. In this case, owner's equity, probably an account called Stefan D'Angelo Capital. Okay, that's what would happen for transaction 1. It's not a revenue transaction, though. Putting capital into the business does not mean we earned revenue. So let's look at transaction 2. Transaction 2 says Sheer Magic provided $6,000 of services during the month of February, and that amount, $5,000, was collected in cash. The remaining will be collected in March. Well, revenue recognition tells us that we record revenue when it is earned, not necessarily when cash is received for those services. So what we would have is an increase in revenue of the full amount, $6,000. Now remember, revenue also makes its way over to owner's equity on the balance sheet, right? So we would have an increase of revenue, in this case of $6,000, and I'll actually label that there. And what else would we have? We would have an increase in cash during the month of $5,000, and we would have an increase in an account called accounts receivable, which represents the amounts owed to us from our customers, since we either provided services or sold goods to them in exchange for their promise to pay us. So that would go up by $1,000. So there we've got $6,000 of revenue recognized. Now let me slide down so we can see number 3 here. Sheer Magic borrowed $5,000 from the bank to help finance 2 new workstations. All right, well, if we borrowed $5,000 from the bank, then what would happen is we would have an increase in cash, and we would also have an increase in notes payable. And notes payable is a liability account. Remember, liabilities mean obligations. And if we borrowed money from the bank, it was probably a written obligation where we agreed we would pay for some amount to pay back, and that becomes notes payable. That's different from accounts payable. Accounts payable is an unsecured arrangement where you agree to pay your vendors or suppliers, and I use those terms interchangeably, in exchange for either services they've already provided or goods they've provided, and you're agreeing to pay for that at some point in the future. But this is a note payable because we borrowed money from a bank. It's more of a formal debt than an informal open line of credit or open credit arrangement. Okay, so we see here there's no revenue on that transaction. Well, how about number 4? Number 4, and let me slide here, says a customer paid $300 as a deposit for a bridal mani-pedi party to be held in March. Okay, now remember that revenue recognition says we record revenue only when it's earned. Well, we haven't done the party yet. So what we have to do is show the increase in cash, will be an asset, right? And then we have an increase in liabilities. And I would probably put this in an account called either unearned revenues, which is commonly used, but maybe it's just called customer deposits. Either way, that increase represents an obligation. We've now collected $300, but we haven't done any work. We haven't earned it yet, so it sits on the balance sheet. If the business were to fail at this point or we decided against it, we would owe that $300 to those people that deposited, that gave us that money, so we could deposit it. Okay? So there's no revenue earned here. We only record the revenue when the party would take place, or actually at the end of the party, then we've earned it. And then the last transaction, let me slide down so we can see that as well, says a customer paid $100 in our bill for services received in January. Well, we've already recorded the revenue if we provided those services in January, because we record revenue when it's earned. So in this case, we still have an increase in cash of $100, and we would have a decrease in accounts receivable. Accounts receivable is another asset account. So one asset account goes up, another one goes down. But there's no revenue to be recorded. So with this in mind, we're able to answer the question, which says, assuming sheer magic recognized revenue on an accrual basis, what's the total amount of revenue to be recognized? And if we look at all of this, we see that right here is where we recorded revenue. Okay, $6,000. And that's the correct answer to this situation.